Okay, can you see my screen? Can one of you
Yes,
respond
ma'am.
if you can see it?
Yes, ma'am, we
Okay.
can see.
Okay, so anyone remembers what did we cover last time? Quickly, one point each one of you. Then we're going to start with the second one. Vanna?
Yes, ma'am, regarding FPARs to be reported once the account balance exceeds 10,000.
Right. Right. So I think, let me just open that if I have it here. I don't have it. Okay. We'll just quickly go over, scan over it, and before we start the next one. So I think the first thing that we started talking about was reviewing prior year tax return. Right. And then we need to have a proper understanding, thorough understanding of prior year return before we even move on to the next year, because there are many factors that may influence the current year return. I think it's stuck or something. And anything else? We talked about information returns. Can someone tell me what all kind of information returns one can have or one can receive? Hemant? It's getting stuck, I think. Hemant is not there. Or Bhavani or Sakshi, maybe you can tell any of the information returns.
Firstly, I would like to just revise what other information that is shown in tax returns. Firstly, for income tax, 1040 and schedule C is there. For W2 is for salary, and 941, 944 is for social security and Medicare. And there are so many different 1099 forms, that is an INT for interest, DIV for dividend, and MISC for other consulting and rental income.
Right.
Yeah.
Right. So we'll just go over that quickly. One is that we definitely need to pay attention to prior year return. We have to go through any of the IRS correspondence if something was done last year. Biographical information, that's very important. Marital status, including marital status, not just date of birth and all, and even dependents, because we take into account the marital status and dependents for calculating US taxes. Okay, then nationality is very important. We already saw a person who is a US citizen or a green card holder is required to file tax return regardless of how many days or how much time he has spent in US. Okay, then I think Sakshi took us through some of these forms. Information returns also, we see these are the forms that we're going to see when we do the tax returns. All the 1099s and all this information is going to IRS through these forms. That's why we call them as information returns. Individual business, we know none of the individual expenses are deductible. There could be some items which are affecting future returns. We talked about carry forward losses or AMTs, any carryovers and all, like charitable gift carryovers, all those things. Then foreign income, we need to see what are the different ways of reporting foreign income, because if the person is a US citizen, then worldwide income is taxable in US. Doesn't matter where the person lives. Okay, whether the taxpayer is in the United States or abroad, that's not the concern at all. If the person is a citizen or a resident alien, meaning holding a green card, we have to understand the entire foreign income he or she must be having. Then we talked about FBAR reporting. Any balance in excess of $10,000 at any time during the calendar year. And we're talking about aggregate value in all different financial accounts. So there could be 5 different accounts, and the maximum balance in those accounts may go up to $10,000 or more. And in that case, we need to report it. 8938 is again very, very important form. So there are certain thresholds for that, depending upon where the person is living inside United States or outside United States. what is the status of the person, marital status, and there could be different thresholds. But if the person is crossing the threshold, meaning if he's having more than certain amount of financial assets in a foreign country, we are supposed to report Form 8938. Okay, and we saw that they are all, they're all a requirement from FinCEN, Financial Crime Enforcement. Again, we saw Form 5471. Anytime a US person is an officer, director, or shareholder in any foreign corporation. Again, it doesn't matter. Sorry, again, it doesn't matter where the person is staying. Okay, when it comes to US tax returns, or when it comes to doing returns for US citizens, it really doesn't matter where the person is staying. We have to follow all the rules as if the person was physically staying in US. Guilty global intangible low taxed income. This is pretty much applicable for a US parent company having subsidiaries in other foreign jurisdictions. And if that subsidiary is a CFC, meaning it is being controlled by US company or any US taxpayer, then we are supposed to report the income which is being derived from that foreign subsidiary. Whether the income is taxable in US or not, that's a separate thing. But the first step is that it should be reported. Then we have to look into certain other criteria, whether it's going to be taxable or not. Then foreign trust, Form 3520, that's very important. Anytime you hear about any trust which is being created outside US, where either the beneficiary, trustee, or in any way a US citizen is involved, we immediately need to evaluate, is there a requirement to file Form 3520. Foreign partnership, this Form 8865, this is again very, very common form. A lot of times, I mean, having partnership is more common than having private limited companies, especially when we are talking in Indian context, because it's very easy to create and maintain. So we always need to ask the person or ask the client whether if they are holding a partnership position. Doesn't matter if they're sleeping partner or an active partner and all. As long as they are having a partnership interest, either in their name or any of their dependents' name, who are being reported on US tax return, could be their parents or children, anyone, or a spouse, then we always have to say if 8865 is applicable. Non-filing of any of these forms, 3520, 8865, 5471, or 8938 will lead to a minimum liability of $10,000 per year. That's a very, very high amount. We need to be extra careful here. And whenever we are starting with the new year tax, I mean, like the tax return for the next year, we always have to see if there are any changes, in any of the personal related matters like marriage, divorce, birth, adoption, and all, or if wage income, any other kind of withholding has been made or not. And we need to take into account all of these different kind of income and expenses as well. Certain expenses or credits are available to reduce the tax liability. So we need to go over them, like child tax credit. So if the taxpayer is having dependents or children who are below like 17 years of age and all, we need to evaluate if they are eligible for child tax credit or earned income credit. So again, there is an automatic 2-month extension for the US citizens or green card holders who are staying outside US. IRS is giving extra 2 months to file their returns. Otherwise, the due date is, can anyone tell me what is the due date?
15th April.
15th April, good. So they get an automatic 2-month extension, meaning we don't need to file for it. But when we want a 6-month extension from April to October, we definitely have to file the extension request form, which is 4868, and it has to be filed electronically, or it can be even mailed out to IRS, as long as we are retaining the proof that we have mailed it. So that's very important. IRS will not give an automatic extension otherwise. Voluntary disclosure programs, there are certain kind of voluntary disclosure programs. The important one that we saw here was a streamline program, and that's very popular and easy to use. So in order to get away from all penalties and all, it's better we file through the streamlining program and disclose all, you know, all kind of position that the taxpayer has taken. And also, like, cover up on all the non-compliance areas. This is what we talked about. Streamlined filing compliance procedure can be of two types. One is for the people, those who are staying outside US, so that's called offshore, and the other one is domestic. It's available for both kinds. Public traded partnership, we saw that if there is, if the partnership is being traded on a stock exchange, then what is that they're supposed to do? Or if there are any partnership share or dividend income which is going to the people outside US or who are not residents of US, then Form 1042 is used, which would talk about the withholding. This Form 1042 is again very important from the other country perspective as well, because that is a proof that there has been some withholding in US. So if the taxpayer is in India and he has a Form 1042, he can easily prove it to IRS that, okay, there was a withholding and this is the reason why they're asking for credits. Okay, that's all we covered. So any questions here? Otherwise, we'll start with the next one. Anyone? No, so shall we start?
Yes, ma'am.
Okay, let's get started.
Yes,
So
ma'am.
this chapter, yeah, thanks. This chapter, this unit, it's very important. It's talking about filing status. These are like one of the very preliminary information that we need to get from the taxpayer. Filing status is very important. In here in India, you would probably not even consider whether the person is married or divorced or single or whatever, or separated and having dependents, doesn't matter, right? But there in US, it's very important because the entire tax return may change completely if we do not put up the right filing status. So what is the most common one? That's called MFJ, married filing jointly. So people, those who are married, they can go for this status, and both spouse should agree to file a joint return. Again, if both of them are signing on the return, that means they are agreeing to file a joint return. Okay, that's the only condition, that they should be married and they should be agreeing to file a joint return. And there are certain conditions here, we can just go over that. So taxpayer can file a joint return even if one of the spouses had no income or deduction. Okay, one can say that, okay, my spouse is not having any income. Why do I need to add him or her on my tax return? So that's not the criteria. It's like, it is still, the income is supposed to be joint income. There are certain state laws or community laws that even if you're married and if income is coming after the marriage, it's considered as joint income. So you can always go for the joint return. So when are they treated as legally married? If for the entire tax year, if on the last day of the tax year they were legally married. So even if someone is getting married on 30th or 31st December, they can still go with married filing jointly status. Just on the last day of the tax year, they should be legally married. It's possible that they're married, but they're living apart, but it should not be out of any kind of separation agreement or a divorce decree or whatever. It should be just because of the various reasons. They could be still living apart. Maybe they have jobs in different cities, or maybe there's some other reasons. that's fine. They can still go with legal, like married status. They can still file as married even if they have a divorce decree, but then it has not been finalized. Okay, so they can still go with it. Then it's their choice. They can go with married filing separately, or they can go with married filing joint returns also. Again, if during the year, if a spouse dies, then status for each spouse is determined when the spouse dies. Unless the surviving spouse remarries before the end of the year. Okay, so if the surviving spouse is remarrying it, then it's different. Otherwise, they can still go with married filing jointly status. In this condition, when one of the spouse is a US person, another one is not, then they should not be filing married filing jointly status unless the person who is not a US resident is agreeing to be taxed on worldwide income. So even if let's say the husband is in US, the wife is in India, and wife is not a resident of US, like neither she is holding green card or citizenship or visa or anything, and she's not staying, still, if they want, they can do married filing jointly, but in that case, the wife has to report total income from India or from any other country that she is having on US tax returns. So as long as they agree to do that, they can still go with married filing jointly return. So in those cases, we need to analyze and see what is beneficial for them. Maybe it would turn out to be beneficial, reporting worldwide income and going for married filing jointly status, taking higher standard deduction, or other benefits which go only for this status. So, and generally, if one spouse is filing separately, obviously the other spouse also has to file separately. So both of them will go with married filing separately status. Unless the other spouse qualifies for head of household. Now there is another category called head of household. We will see that later. What is head of household category? And once a joint return has been filed and the time for filing the return of either spouse has expired, the spouse may not amend the return to file separate returns. So once they have filed joint returns, generally we will not amend to file them separately. I mean, if they still have time, they can do that, but usually it's not allowed if the time has expired. Okay, any other married individual who are filing separate return, they can always amend it later. If an individual obtains a marriage annulment and all, the individuals must file amended returns, claiming status of single or head of household, whichever applies. So basically later on, if they get some annulment done and all, saying that, okay, they had been filing married filing joint status, but actually as per law, they were not married, or maybe some of the conditions were not satisfied. So we don't call it as a valid marriage as per the law. And in that case, it would consider to be a marriage annulment, and they'll have to go back, amend all the returns, and use the right status. Either it could be single or head of household, whatever. Okay, so there are certain conditions here. One can go through that. Then there's something called joint return is signed by both the spouses, but there's something called innocent spouse relief. Let's say both of them are signing, and one of the spouse, she or he doesn't know what the other spouse must have like fraudulently done something on that return and all. But if they both of them sign, they become jointly liable. So there's something called innocent spouse relief, which this is the form 8857. We can file with IRS and tell the IRS that, okay, I'm the innocent spouse. We don't know about what's going on. There was this possible understatement of tax or some false deduction of credits have been claimed. So give me the relief. And in that case, IRS will go for the recovery of taxes. They will go after the other spouse. Then there's something called injured spouse. So when a joint return is filed and only one spouse owes a past due amount, there's something for past due. Okay, this is important. The other spouse can be considered as injured spouse if they say that, okay, I have no idea about what was happening in the past and all, and the other injured spouse doesn't want to take any liability, they can file this form 8379 and they're not required to pay the past due amount. So the liability goes only to the other spouse who is actually responsible. Typically, if they're both are filing a joint return, both of them are signing, then IRS can go and after any one of them if there is any tax amount due. Okay, so in that case, these kind of reliefs may come up. Same-sex spouse, okay, in a lot of in some of the states in US, well, they have allowed the marriages and all, so they get all the rights, but this rule only applies to married individuals and not to those who are in domestic partnerships or something. So they have to be legally married. So that's also allowed in US. And I think there have been some Supreme Court rulings from 2015 and also there's been a lot of uh, things happening, like they want more rights and all those things. So at least same-sex spouse can file joint returns with IRS only if they're legally married, but just not by having any domestic partnership. That doesn't apply. And not every state has recognized the marriage, so whichever state is recognizing, they can get married over there and file the return. Any questions so far? So what we have covered is only married filing joint category. There are certain conditions. If those are satisfied, if the marriage is legal, if they got married during the year, if they're staying like a married couple, then they can definitely file married filing jointly. They don't have to go with married filing jointly. If they decide they want to file separate returns, they can definitely do that. In that case, both of them will be filing separate returns and they would report their own incomes. If one of the spouse dies during the year, then what is that, what is the other status the other spouse can maintain? That also we saw. Head of household is another category where the person is not married, but the person is running the household. That's why they call it head of household. So that person is basically taking charge of all the expenses of running the household. Then there are certain conditions we saw, like how can an injured spouse get a relief? Or how can an innocent spouse get a relief? Injured has something to do with the past due amount. Innocent, it can be current amount and all. If the spouse doesn't know, how the money has been earned, or if there has been any fraudulent claim of any credit and stuff, and the spouse doesn't want to take any liability, they can go and file this form with IRS saying that, okay, I'm the innocent spouse, so get me out of it. I don't want to bear the burden of tax or any wrongdoings. Okay. Any questions so far before we go to the next status?
Ma'am, I'm having doubt in point D. One joint return is filed and time expired, then the spouse can't amend or file the returns. This point.
Yeah, so there is right. So there is, it's not like it will be open for all the time. The time to amend the return. Usually 3 years are given by IRS. So if that has expired, they cannot go back and amend the return.
If the time is not expired, then the spouse can file the return separately?
Yes. Yes, then they can go back and file it. They can amend it and they can file it, but both of them need to amend.
Okay, ma'am. That was my doubt, like both of them need to amend or...
Yes, obviously, because both of them need to have either the same status of married filing jointly, or they can have married filing separately, or one of them can have head of household and married filing separately. But you cannot have married file jointly status when the other spouse is having married filing separate status.
Okay, ma'am.
Right? So it needs to be in sync with each other. Otherwise, IRS will send a notice saying that, okay, we don't accept it, or they may nullify the other return which was filed.
Okay, ma'am. Yeah.
Okay. Then there's something called merit filing separate return. So each one of them, they will have their own income and expenses to report. They'll file their own separate returns. And if they're having kids, they can see who has the custody of the kids. I mean, if they have a valid court order or who is supporting the kids, according to that, they can claim dependents. So a spouse who uses his or own funds to pay expenses of jointly owned properties entitled to any deduction attributable to the payments. So the person also has to use their own funds. They need to be able to prove that this is the fund that they are using personally from their bank account, and that's why they're claiming the deduction. And this all becomes important only when they're going for merit filing separate returns. When they're filing jointly, it doesn't matter who is paying how much for what expense, because it's all considered to be one account. Okay, let's go to the next one. There's one status called qualifying widower. So again, this status is given only when one of the spouse dies during the year. And this is a special status which is available only for 2 years following the year of death of the spouse. Okay, this is available only for 2 years. It's not like you cannot take this qualifying widower status for a long time. And this status gives some kind of benefits. It definitely has certain advantage. It's kind of relief given to the to the surviving spouse